The Dentalpreneur Podcast. Okay, doctor, it's time to put down that handpiece. You're listening to the show dedicated to helping dentists get their lives back. It's time to decrease your stress, increase your profitability, and regain your passion. Now introducing your host, Dr. Mark Costas.
Hello, everyone, and welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas. What is up, my friends? I hope you're doing great out there today. Just hot off of a really cool trip to Austin, Texas. We went to the F1 and really got a huge education in racing in general. Never been to an F1 race before, and I found it extremely interesting. There was about 250,000 people there with me over that weekend. A total of almost 600,000 people came to the event, and it was really cool. I got the inside scoop on some of the drivers, and now I'm watching the HBO. The Netflix special on F1, and I think it's going to be something that I start to look more into and follow a little bit closer. But anyway. That's what's happened in my personal life. Been traveling a lot. I'm going to Puerto Vallarta this week on behalf of Smile Outreach International. We're looking for our permanent facility, a place that we want to buy and create a sustainable charitable dental clinic down there in Mexico. So really excited about that. Have some other really cool things on the back burner, but I will keep you all posted as far as that goes. I'm excited today to welcome a new friend. His name's Greg Auerbach, and he's a second-generation dental professional. He holds a computer engineering degree from UCF, and an MBA from Wake Forest. With nearly 20 years of experience, he specializes in consulting, appraising, and transitioning dental practices across the United States. Now a senior director with Henry Schein Dental Practice Transitions, Greg leads sales enablement and marketing in North America while managing valuations and operations within the U.S. He serves as the managing broker for the Florida team. Greg, welcome to the podcast. How you doing, buddy?
Great. I was just in Austin too. I didn't know you were there. We were there last week. I didn't get to see racing, but we were there last week.
Oh my gosh, it's been crazy over there. So they did Austin City Lights, and then they had the Georgia UT game, and they had F1. I don't even know how that city accommodates all of those people coming in. It was crazy. It was nuts.
I mean, it was. I was only there for a few hours. We flew in and I spoke at an event there on Friday and got myself out. But I mean, there was a lot going on. That's for sure.
So what was the event? I bumped into somebody in the elevator that had a Cavo shirt on, and I asked what he was there for, and he said he was speaking to a group of dentists at a brewery.
We weren't at a brewery. We were just at a hotel, but there was a big event. We had 150, 200 practitioners and their staff talking about digital learning, and I was there obviously talking about practice transitions, practice valuations, but it was a big all-day event. I think there were a couple more. We got one in Orlando this upcoming week, a couple more around the country, California and Massachusetts in a couple of weeks as well. So, we're out just trying to get message out there. Help people to learn, help practitioners to learn what value is in practice and how to grow value. Because, to me, I didn't practice. As you said, my dad practiced for almost 20 years in Seattle. Mm-hmm. And, in valuing practices, I don't see it just as, it's not a one-time thing, it's one time in the transaction component of itself. But if you're building value in your practice, you're building cash flow and money in your pocket day to day. So to me, it's just about what are you living on, on a daily basis? What's good for your family? What are you traveling on? What are you doing to earn more money? Mm-hmm. And that's building value at the same time.
Yeah, I couldn't agree more, Greg. Maybe you can tell us just a little bit about your background, and then I have some very specific questions about valuations, what you're seeing in the marketplace nowadays, and that sort of thing. How'd you get into dentistry? It was clearly because of your dad, but tell us a little bit about the story.
Yeah, I mean, I went to UCF, as you said, here in Orlando. I live in Orlando for undergrad, and I was a computer engineering undergrad. And I didn't realize till the very, very end that I had no desire to do computer engineering. It was good training. It was a good baseline, a lot of logic. It was a very strenuous course load. But yeah, actually doing it in practice wasn't very interested. So not so long after that, and I graduated actually December of 2001, right after 9/11. So the marketplace for computer engineers was basically in defense anyway, and again, not interested. So coming into the spring, I applied for grad school and went to Wake Forest for grad school. Coming out of grad school, my dad, who actually had to retire from practice in the early 90s and started doing this. He does this for our team in Southeast Florida. He said, "Why don't you come join us?" And I evaluated a lot of things, eventually got my Florida real estate license. And coming out of grad school, I joined the team. And a few years later, I bought out the founding member.
Oh.
A few years later after that, we sold to Henry Schein, and we've been with Henry Schein for about 10 years now as the Florida team, essentially.
That's awesome. That's awesome. Okay. So I'm sure you see a lot, very interesting transitions. Lots of people approach you with their P&Ls, not really knowing how to evaluate their practice. I've had 16 dental practices myself. My practices that I've sold every one of them to different types of parties, and they're evaluated differently depending on the situation. So, the old back of the napkin math used to be some percentage of gross revenue, right? So if you had $1 million practice, depending on where you were, you could get, 60 to 75% or 60 to 85%, 60 to 105% of gross revenue. And then, you'd have some sort of a doctor to doctor sale, and there'd be quality of earnings. I don't even know if they call it that, but some sort of, neutral third party looking at the kind of financials of the organization. You bring that to the bank, they either say yes or no, and then you move on from there. So what is the typical way that you are valuating practices now? Some multiple of EBITDA, or a percentage of gross revenue, or a mixture of the two? How are you guys doing it over there?
Yeah, so that's a lot. So that's probably a full day seminar right there. And just the question, but that's good. It's good. Because look, these kind of questions come up all the time. And, to start where you kind of started, the percent of gross is out there. Back of the napkin, I'm not going to say it doesn't get you in the ballpark. I'm not going to say it doesn't validate itself in a transaction at some point, but it's not value. Mm-hmm. And it's certainly not looking at the specifics or the details of what a practice might be.
Okay.
I mean, in that case, my classic example is if I got two practices, that are doing $1 million each, and there are 6 operatories, but one of them has brand new equipment versus the one that has 30-year-old equipment. Are they worth the same? I mean, probably not, because you got to put investment into the one that has older equipment. Mm-hmm. Similarly, if you've got 2 practices, $1 million, 6 ops, maybe they're all brand new operatories as well, but the overhead, one of them 60%, one of them 65%. Well, one's more cash flow. There's a better deal there. So why would you pay the same? So, the percent of gross, again, back of the napkin, I get it. But as far as like where my head is and what we do in actual methodology, that doesn't get us there. And so, we use different methodologies as far as going through the process itself. And I'm gonna save, if you give me, I'll come back to EBITDA and Q of E. Just give me 1 second to get there. But we actually use methodologies, including looking at the market itself, which is comparables. It's a very difficult situation to look at because practice sales are not a public, they're not publicly recorded, not like real estate. Yep. So, we have to rely on databases and information that you have. And, we as a company evaluate 400 to 500 practices per year on a valuation level. We sell another 400 to 500 practices per year. So we're just churning a database. And so being able to pull comparables for a market value, if you will, which is, if you want to compare it, is something you'd look up on Zillow or Realtor.com. Like, that's market value. That's what they're doing, is they're doing comparables. And so you have to have a good database to get there. And fortunately we do. But beyond that, we use the asset summation method, which is a business valuation methodology where you're looking at, what's the value of your tangible assets, the tables, the chairs, the computers, the things that you can touch in your practice, versus the intangibles, which are the patient records, phone number, reputation, kind of adding all that together. That's one methodology. And then the third that we look at is an income method. So we're looking at cash flow. Primarily, we focus in on the capitalization of earnings, which is monitoring risks versus net income. It's highly based on the idea, the premise that a third-party investor is owning the practice, and that third-party investor is making the money off of that investment and employing practitioners to do all of the dentistry that needs to be done. But it's essentially saying, how much money do they want to make and how much risk are they willing to take to get there? And that builds back value. So the capitalization rate itself ends up monitoring risk. And so we go through essentially a full assessment of the practice to assess what risk is. And then we clean up the cash flow to see what the practice's actual net income is. I had one case where I sold the practice, so the doctor had this repair and maintenance bill that was probably 10 times greater than we expected it to be. And of course, that kind of thing stands out, right? And I went into the doctor and I said, what's going on? What's in your repair and maintenance? And because it's not right. And he legitimately said to me, he said, oh yeah, that's my airplane. I run my airplane through the practice, not a legitimate business expense. And I said, can you prove it to me? And we were sitting in his office and he rolled over to his credenza and pulled out a binder. It was probably this thick. And he said, does this work? You want this? And I said, no, I don't want it. That's sufficient. I get it. You've proven it to me. If we need it later, I know where to find it. But that's not an expense that we would keep in a cash flow to get to net income. We clean that kind of stuff out. But we actually look at all three methods to get there. And it's not just, throwing a dart at a dartboard to say this is what it might be. We go through and try to get them to align, try to understand exactly what the practice is, what that risk level is, where the money is, and how that works.
Yeah.
That's at EBITDA and Q of E, similar processes. Typically, those are reserved for the larger practice transitions, something that would be going more corporate, especially Q of E. Q of E is quality of earnings. For all of you that may not know what Q of E stands for itself, but that's actually like a deep, deep, deep dive into financials. And typically, our partner company, LPS, who we work with, who does our large transitions, they actually will take your QuickBooks, download it, and go line by line for a couple of years worth of data to clean out your quality of earnings and understand. And it's exactly what that is. It's understanding what is the net income and how clean it is and getting it to a point of being clean. So that's Q of E. And then EBITDA is almost, the way I like to talk about it is the inverse of the capitalization rate. But EBITDA is that multiple that's out there. And so when you said, do you use EBITDA to get to valuation? Kind of. We don't use it as much as a multiple, but we use it in the capitalization methodology because EBITDA, earnings before interest, taxes, and depreciation, is that cash flow item at the end of the day. So we try to get to understanding what that clean cash flow is. And then it's a matter of what you do with it. In the larger corporate, they typically will multiply it for the EBITDA. And then for us, we will typically go with a capitalization of earnings and divide by it. So it's either a divisor or multiple, either way.
Got it. All right. That was a mouthful. Yeah. Chip and I, from Large Practice Sales, have had many, many deep conversations. He's been on the podcast at least a half dozen times. So he and I have talked our way around this lots and lots of times. So what is the threshold, would you say, when it is best to sell doctor to doctor versus when you're looking to sell to an institutional buyer like a private equity backed DSO? What is the gross revenue or EBITDA tripping point?
You know what? To me, it's not a dollar. To me, it's not a dollar decision at the first place. It's a matter of what you want as a practitioner, like what's your lifestyle, where are you looking to go? Are you looking to transact and leave? Because in that case, most of the institutional acquirers aren't going to be interested. Part of what they're investing is you and you as the practice. And so they need you to stay. So if you're not willing to do that, that's not really an option, no matter how big your practice is. Once you get kind of beyond that decision of where you want to go and what do you want to do in practice, I think the conversation comes down to, how much cash is there and who is available to buy. But, there's a range, I would say, and it depends on the practice. It depends on the practitioner, especially, let's say, a GP, just for the sake of conversation. Once you get to somewhere over $1.5 million and to $2 million in collections, you're getting out of the realm of where a private practitioner can be the buyer. Mm-hmm. You're getting out of the realm of where someone can do that work themselves, understand how to operate it, or even get the loan to do it. Mm-hmm. And so then you start getting into your only choices are some institutional acquirer. And there's a large, range of who those purchasers are too, mm-hmm. because there are some that will keep you for a short period of time and pay you mostly in cash. And then the larger you get, and the more you get into to private equity dollars, you might be talking more by way of multiples or total enterprise value, TEV. But again, your strings are a little bit tighter. You might have equity in the deal. You might be holding a note. It's less cash. The deal structure changes. So to me, it's a lot more about what's your lifestyle, where are you in your head, as opposed to where you run over a tipping point is the size of the practice. If that makes sense?
Mm-hmm. Sure. Maybe you could share some trends that you're seeing. One of the things that I've talked to with Chip and lots of other brokerages about is this new wave of younger docs that are taking chips off the table and selling their practices much earlier than previous generations, with much different outcomes as far as valuation of their practice, multiples of EBITDA, and being able to still see kind of a long horizon of a career ahead of them, maybe as a minority owner in their practice, or perhaps selling out completely and working back to an organization. So that's just one example. But what are some other trends that you're seeing in the marketplace nowadays for people that are transitioning out of being the sole or primary owner of their dental practice?
Yeah, there's definitely a growth in that space. And I know Chip talks about that a lot, and Chip and I and his team and I, we're talking multiple times a week as well between our teams and just myself. So I get that. I think part of that is we have more practitioners that are out there than were even 10 or 15, 20 years ago. Mm-hmm. And so there's more availability and more opportunity for those kinds of transactions. I think that, there's also a wider range in decision points of what you want to do. But look, practice sizes are larger overall. We transact more larger practices than certainly we did 10 or 15 years ago. Mm-hmm. And that's just an overall uplift in practices, on the whole. I think one of the things that we hear a lot is there aren't enough patients for a practice in whatever area. And the statistics just don't say that. It's just a matter of what kind of practice you want to operate. And, if you want to lessen the burden, or you've grown in some cases so fast, because we've seen some practices that just explode, mm-hmm. which is great for who the practitioner is or how they're operating or what they did, but sometimes it can be overwhelming. And the need for that institutional buyer comes up, and to be able to step back and not have to operate, full-time, 5 days, 7 days a week, not taking vacations or what have you. So I think that there's a balance there, or a difference, a growth there. I do see a growth though, again, because of practice size. There is a growth in just private practice sales as well. I think it all is being fueled the same way. There are more practitioners coming out of school. Higher debt loads mm-hmm. Haven't precluded someone from being able to acquire, but it may require them to buy something larger. Mm-hmm. Fortunately, again, we have larger practices that are typically out here. So that's where I was saying that range, it's between $1.5 million and $2 something million as far as what a practitioner can get to. That's certainly gone up from the days of when I started, which was, if the practice was over $1 million, it was very difficult for a lot of purchasers to get to. Yeah. But a lot of purchasers need to do that too, because of what their debt service are. Mm-hmm. So we have that available, but look, money is here too. I just heard today on a transaction that we're back potentially below 4% on interest rates for 100% financing on practices.
Wow.
We maxed out, I think, in the worst part of this inflationary and higher interest rates periods. I was thinking maybe 6 to 7, which is, I mean, that's lower than anything else that's out there. When I was cash flowing and starting in the business, we were in the 10% range. Yeah. So the idea that we're back around 4, money is incredibly affordable as it is. And so access to these practice really just comes down to what can you do? So this is all just fueling value. It's fueling the marketplace overall. There's a lot of demand that's out here for quality practices. And in a lot of cases, for a lot of parts of the country, whether it be private or institutional, we have a hard time keeping them on the market. They just sell that quickly.
Yeah, that was going to be my follow-up question. What are you seeing as far as the appetite for purchasers, for practices that are on the market? Is this a buyer's market? Is it a seller's market? I guess the fact that interest rates have dropped significantly just this year, that changes things, the appetite for people that want to buy and the availability of inventory out there.
I mean, interest rates are a funny thing. And, I live in this world because I'm the MBA and I deal with valuations and looking at these numbers. But, a 1% change in interest rates, might equate to a couple of crowns a month in difference of cost. It just doesn't equate to a lot, but, psychologically, it's a big deal. Mm-hmm. So money has been available and money has been relatively inexpensive in dentistry for a very, very long time in reality. So, the money being available isn't a challenge. I think the bigger question, or where the market is driven, is more location based. In certain parts of the country, you could be in a buyer's market because there are more practices than there are buyers. And it's a lot of places that may not have a beach or a mountain right near it that somebody really wants to live in. Mm-hmm. For larger cities and more, suburban type places, people are moving, weather is good, just those ideals of where someone wants to live, definitely a seller's market. And, the caveat in all of this is, especially on the seller's market side, look, it still has to be affordable. It has to work for a buyer. And that's what I've always counseled my sellers on. You can ask whatever you want, but if it doesn't work for a buyer to, 1, live off of, and 2, get a loan, you're not selling anything. Mm-hmm. So, it still has to be within market, but there's a lot of flexibility in the market overall, especially for quality practices, and that are doing a lot, doing more, because unlike most businesses throughout the country, especially, but throughout the world, U.S. dental practices have a pretty solid profit margin. So there's a lot of room to kind of suck up the cost of what it is. Mm-hmm. Be thankful you guys are dentists. Yeah. Because a lot of businesses don't transact like you guys do.
Yeah, that's true. All right. So when you come across a potential client and they hand over their P&Ls and you're doing kind of this valuation exercise, and you see, you said that your original kind of case study side by side was like 60% versus 65% overhead. I've seen practices on the regular that are like 85 to 100% overhead, and they're not profitable at all. So if you come across a practice that looks like, it's producing well, but it's not profitable, and there's room to improve cash flow significantly, do you usually say, all right, here are some things that you could do? I'm going to give you 6 months and we're going to check back in, because right now your practice is strong from a top line perspective, but very weak from a bottom line perspective. What do you do when you encounter a situation like that?
Yeah, I am thankful, because when I came into the business, my team in Florida was 2 MBAs and 2 former practitioners who ran quality practices. One of them was my father, but he stopped practicing, like I said, in the early 90s, and he was doing just under $1 million of collections. So he was doing something right. Between learning from them and then I sat through a lot of practice management courses, probably a lot more than a lot of practitioners did. Mm-hmm. And so I've kind of learned the ropes on, what can make a practice operate better. So yeah, there are a lot of those cases, whether it be valuation or sale, that someone says, let's look at these numbers. And we say, look, we need to tweak some stuff. And I'm going to give you some targets. I have resources to help you to get there because I'm not a practice management consultant. But we just last week, we were talking to one of our sales reps who had a local doctor, and we looked through their financials and they were in that like 85% range. And we said, look, I've got nothing to value. We need to help fix the practice. You could go to market, but we might not be able to get a sales price because it may not cash flow for the lender to do it,
right?
So that a purchaser can live off of what's left over. And it was a sizable practice. So, fortunately, between practice management and looking through hundreds of practices per year, even myself, we can typically look and see through the P&L, and especially through our analysis, to say, look, your lab expense is running high. What can we do here? Why is your technology expense here? Why is this here? And start targeting where percentages are high. And then the other thing is I've done with other doctors to say, I don't need you to get 10% out of this category because you don't have it to get there. But what about 0.5% out of a few? And I never want to, and I'm very cautious and have this conversation pretty direct, don't go to your assistant who does the ordering and be penny wise. Don't start like really squeezing everyone in the practice because they're going to feel it. But if you kind of take a holistic approach and everybody starts to be mindful of where things are, and we do get back maybe in collection fees through your credit card processing or whatever it may be going, that we get, again, 0.5%, 1% here, and through other components, and we can get 10 and 15%, which ends up being pretty easy in those 85% overhead practices. And we can get you down to a reasonable level. Ideally, I'm getting you down to 65, 60, or 55. And we typically can have a way to get there. We will get the resources together. I have another one where I said, we need to get some of your money out of your overhead, but then I want to look at your reimbursement rates for PPOs. I want to look at your fee schedule. I want to look at your hygiene. And we have a tool within Henry Schein that can help target on this. But I specifically said, without even looking at that tool, saying these are the things that we need to do. And it's not just looking at your expenses, it's potentially looking at your revenues, because percentages, can run. If you run your dollar stable, but you increase your revenues, your percentage is going to go down. So let's figure out looking at both ways and making them diverge, get the percentages and the dollars to go down, the revenues to go up. Then we get that delta and we get the actual overhead where we need it to be. Again, and that's where we started with. That's more profitable for you now. We can help fund your retirement, fund your lifestyle. You could travel more, do the things that you want to, but I'm building value at the same time for the transition later.
Yeah, it's a great answer. I mean, when I talk to people about looking at these bloated practices that where not a whole lot of effort has been or attention has been put into kind of analyzing a P&L and like the difference between a fixed and a variable expense, it's like, okay, let's squeeze these variable expenses as much as we can. But when it comes to like elevated fixed expenses, the only thing you can do to fix that is to increase revenue. So what's going to be the strategy to increase revenue? But first, let's look at where the holes are in the bucket, and those are the variable expenses that are unnecessarily high. We could tweak those, fix them 30, 60 days, no problem. But in a lot of cases, those fixed expenses are what the problem is. So you have a revenue issue. In order to get that cash to flow, you need to increase your revenue.
Well, one of those is like rent, and especially in some cities in the country, what rent is going to be whatever rent's going to be. It's a matter of how do you leverage your facility at that point, which again is going to be in your revenues like you were talking about. How are you going to leverage your facility to make sure that rent payment makes sense in the scope of your practice?
Right, exactly.
Because that's ultimately what it is, because you're not going to fix it. Like that other fixed expense, which is, back to MBA world, fixed versus step versus variable, is staff costs. And, how are you staffed? How are you paying the staff? Are you giving annual raises when it's just because you feel like you're being nice? Dentists are very nice people, I found. We practitioners, we end up giving raises maybe when someone doesn't deserve it because we just give annual raises and then we don't raise our fees. And I'm saying we like I'm practicing, but I feel like I'm part of the community. But we don't raise our fees because we feel that our patients either can't afford it or whatever it may be. And then that goes on for 5 or 10 years, and we're dealing with a fee schedule that's way out of whack because we've never raised our fees. But at the same time, everything else costs more money.
Mm-hmm.
Nobody stopped raising anything else, but we as a practitioner, or use a practitioner because you have the patient sitting there and you don't want to charge whatever it is for the crown. You didn't raise your fees. And then again, you're out of whack. You've lost profitability and it's coming out of your pocket to do it.
Very good point.
I just, again, I associate it with being really nice. We got to be good business people too.
Agreed. Indeed. So what are you seeing as far as percentages, like the deals that come across your desk or potential deals that come across your desk? What percentage are going doctor to doctor versus private equity or DSO, private equity backed DSO?
Yeah, look, I think that the majority are still going private practitioner. I think that there's a big conversation about that transactional model is dying. And again, I think some of it is because of the feeling of debt from purchasers and the inability to purchase and the inability to get money at a reasonable rate, which again, 4% is pretty solid interest rate right now.
Yeah.
So I think that that's more hearsay. Because the other thing is that private sales don't seem to get as much rah-rah because there's not a big company behind it promoting it. So I think that the overall DSO market, which is, varied somewhere between the 15 and 25% of the overall market, depending on who you're talking to and how you're talking to them. I don't know that that's changed. I still see that a majority of transactions are private. The vast majority, again, that 85% are private transactions overall.
Interesting.
Because going back to the other things I was talking about, a lot of practitioners would prefer a private practitioner to take over the practice, and or the practice just isn't large enough to be a DSO type acquisition target.
Sure.
So it may get rolled up into a local type DSO. But I would say a solid majority, if not 80-85% of them are still private practitioner sales.
Got it. Just one more kind of line of questioning before we end here, and thanks again for your time today, Greg. So you're using kind of this normalized P&L example of an airplane. There's two sets of books, kind of, right? So you have you have a set of books where you can write certain quote unquote expenses off and put things through the business. Maybe a couple cars, maybe a boat or a vacation rental or like an airplane. So justifiably, you could probably defend that in an audit. So that's decreasing your tax liability by running these expenses through a business. And then at the end of the year, you can kind of normalize or at the end of the day, when you're looking to put the practice on the market, you can say, well, this is either a one-time expense or this is, I'm going to remove this because the future owner is not going to have these same expenses run through the business. So you get a normalized P&L with kind of a realistic cash flow and a realistic profitability, right? So what are some of the things aside from an airplane that you see that most practitioners can remove in that normalization process?
Well, first of all, the second set of books doesn't exist, right? It's very, and in certain parts of the country, there's a lot of cash in those second sets of books too. So let me address that first. Cash, if it doesn't make it to the tax return, we don't get to value it, and it doesn't get looked at from the bank's perspective. So if you're taking cash out, for whatever reason you're taking cash out, you're getting the benefit of taking the cash out. Mm-hmm. So that's what that is. We've seen, cars typically go on there as auto, and those are very clear. The airplane obviously was not as clear because it was buried into repairs and maintenance. Mm-hmm. And just having an airplane listed on a dental tax return doesn't necessarily make a lot of sense unless you own a few practices and you're flying between them, which then could become a legitimate business expense, at least for that business. Yep. There's the things that get buried a lot of times, janitorial at home and the office, like it's the same person. We had home offices get written off through the practice as well. Trips to Costco, BJ, Sam's Club, whatever, you're buying sundries and toilet paper and paper towels for the practice and you're doing it for home. I've had dry cleaning get pushed through the practice. I think the biggest one that stands out that really has to be disclosed would be running family members through the staff, through the office,
spouses,
I have
kids.
spouses as well, particularly that aren't working in the office. And that's a double-edged conversation, but the first one is like, I've got 3 girls and I don't own the business, so nobody gets run through my business, but my 6-year-old's the janitor, type thing. And we pay her $65,000 a year, in salary or whatever it may be. Again, I don't own it, so I don't get to do that. But we have seen that before, where every family member is doing something in the office. But the spouse one, especially like when they're not working in the office, it's the same idea. And sometimes it's to fund retirement, which again, I get it. And we just ask for it to be disclosed and we clean it up. If though you have someone who is a spouse and they are providing a legitimate, job role, maybe typically it's front desk, sometimes with hygiene in the office. If they're not going to transition, then we need to come up with a transition plan for them. So if they're not going to stay post-sale and work to transition in a new person that's going to fill their role and do it properly, and front desk and hygiene are the 2 very key pieces of that. There are a lot of cases where I've looked at the doctor and said, yeah, we need to get your spouse out of the front desk like today. Let's find someone, start training them now. You're going to burden that expense. You've had the benefit all along. But if your spouse doesn't want to stay for 6 months or a year afterwards, we need to do that after. We don't get to write them out of the pro forma. They still get calculated in. That's a legitimate business expense. But outside of these other kind of oddities of like the airplane and cars and stuff, the spouse is probably the next largest expense that ends up being thrown into an office. And like I said, if they're legitimate, we need to come up with a transition plan. And if they are legitimate in that we're just passing money through them, then we would clean them out. We're not the IRS. I'm not reporting to the IRS. I just want to get a clean feeling of what the practice is actually doing.
Sure. And the bank's going to look at that with a magnifying glass as well to make sure that everything's legitimate.
Well, and when you talk about Q of E conversation and the bigger practice transitions, those are the details that they're specifically looking at. But those are the things. Look, sometimes the spouse is overpaid for the role that they're actually providing, which is, again, I don't care how the business is run as it's run. We're trying to figure out how it's going to be operated by someone else. And whether it's an evaluation as an investor, as a third-party owner, or in the transaction and setting up the sale itself, then we want to see how the buyer is going to run it. And again, if those things aren't legitimate business expenses, again, you run the business however you want to now, but be ready because we're going to start asking questions. And again, it's not inquisitory. It's just to try to get to a real picture of what that practice is.
For sure. So if somebody comes to you, everything's pretty clean, their books are in order, you normalize the P&L, or not much needs to be normalized. What is the length of time from beginning to end of the typical transaction?
That's a loaded question, and we answer it.
Yeah.
So I will qualify this as to when we get documentation. So we, the hardest part of the process is you as a doctor gathering everything that we need.
Yeah.
And we ask for a lot of stuff. We ask for a lot of stuff, but we look at everything that we ask for. And especially when you get to the point of a transaction, somebody is going to look at it, whether it be the purchaser, the bank, the purchaser's accountant or attorney. Like, we're asking for things to get ahead of it. So the longest period is typically the doctor getting everything together for us. Once we have it, right now we're probably at 2 weeks to 3 weeks. I'm working very hard to get us down to a week. And I'm hoping next year we're getting there, that we're getting an answer back for you pretty quickly overall, especially if we don't have back and forth as far as questions goes, and everything's complete. We can get it done actually very quickly. Sometimes within days if we have to. It's the back and forth. It's the questions though. So when you qualified it as a clean P&L with very little, that's a big difference than most of the time what we get. But we're used to the other part of it. So
I'd imagine. Yeah. Well, awesome. Once again, Greg, thank you so much for your time today. What's the best way for people to get in touch with you and maybe start the process of taking a look at their practice and going to market?
Yeah, of course. You can certainly reach out to me directly, and I can get you in touch with our local rep. I can, my email address, and I can spell it. I can send it over to you guys. It's greg.auerbach@henryschein.com. So it's greg. The hard one, AUERB as in boy, ACH @henryschein.com. Our website is henryscheindpt.com. It's like dentalpracticetransitions.com. And so there's a wealth of information there as well. But, look, I'm here to help. Again, I've worked with practitioners for 20 years. My family's practitioners. My mom was a hygienist. So, I know it all comes down, a lot of what we talk about comes down to that transactional component and value and stuff. But like, I'm here to help. And like I said, I tie all that together. I want you guys making as much as you can for whatever you need and whatever you want in practice now, because it only helps everything later. So happy to answer questions as well.
Awesome. Well, that was awesome. Thank you so much for sharing your insights and wisdom with us today. It's been fun. Hopefully you can meet in person sometime soon. I'm at a lot of events that you are at, I'm sure. So I will see you in person sometime soon, I'm sure.
Looking forward to it.
All right, ladies and gentlemen, Greg Auerbach.